having me. Yes, I'm here to tell you about the considerations we made during Skandia's mutualisation process a few years ago regarding access to external capital. Skandia is a Swedish mutual insurance company and parent company of a group of companies conducting insurance, banking, mutual funds and investment services primarily in Sweden, and we have around 2 million customers. And Skandia is owned by its customers and controlled by the customers through a board of delegates, and is completely independent from any interest organizations or other interests. As at end of March, Skandia Group managed assets corresponding to around 65 billion euro. And for the purpose of this case study, it is useful to take a step back and ask why Skandia was mutualized. Before Skandia was mutualized, Skandia was a company limited by its share, run on a mutual basis. In other words, Skandia had a ban on profit distribution in its Articles of Association and was therefore entirely run for the benefit of the policyholders. In Sweden, we call these kind of companies hybrid insurance companies. In the 60s, the life insurance company Thule, which was then in severe financial difficulties, was acquired by Skandia Insurance Company, a listed insurance company. Thule, which was later renamed Skandia Life, was already then run for the benefit of the policyholders and was allegedly acquired by Skandia only because of its state-of-the-art mainframe. For many years, the mutual character of Skandia Life did not create any problems, perhaps because it was not given much attention. However, in the late 19th and in the beginning of the 21st century, a series of transactions between Skandia Life and its parent company was questioned as there was perceived to be in conflict with the ban of profit distribution. This started a period within the Skandia Group with heavy attention on corporate governance of company run on a mutual basis. How much control of a company run on a mutual basis was allowed from a ban of profit distribution perspective? And this question seemed to be popping up in virtually every context. By this time, the parent company of the Skandia Group had been acquired by the South African-based insurance group Old Mutual. As their ever-emerging question of the ban of profit distribution seriously hampered the business, Skandia Life made the unusual decision to acquire its parent company from Old Mutual. It was a complicated transaction, and time does not allow me to go through that in detail, but when the transaction was completed, Skandia Life was owned by a newly founded foundation, the Thule Foundation, and its previous parent company, Skandia, was a subsidiary of Skandia Life. Now, the Thule Foundation was only allowed by the Swedish FSA to hold the shares in Skandia Life for a limited period of time, that is, until Skandia Life was turned into a pure mutual company. So, it was not a question of what the benefits of mutualization Skandia was. Skandia Life had to mutualize. There was no other possibility. There are truly many benefits of being a mutual, and it was also the wish of everyone involved in the transaction, but it was not a necessary consequence of the transaction, which originated from the problems caused by being a non-profit distribution entity within a profit distribution group of companies. During the course of the mutualization, the Thule Foundation considered Skandia's alternative to maintain its capital strength through access of external capital Today, I will revisit those considerations and explain why it was decided to refrain from such opportunities. But first, some words on the Swedish life insurance market. So, the Swedish life insurance market is a highly competitive and a mature market. The four biggest companies, in terms of paid-in premiums, are either pure mutual or hybrid companies. The other companies are profit-distributing insurance companies. In Sweden, insurance companies offer occupational pension products and occupational pension stand for the main part of the Swedish life insurance market today. Skandia offers occupational pension products as well as private insurance and endowment insurance. Skandia is the market leader in life insurance with a combined of 15% of the Swedish market. As I said before, Skandia is independent and does not have any other interests than the interests of the policyholders. Skandia is unique in Sweden from that perspective, as other life insurance companies either have ties to labor or business federations or insurance or banking groups. We are proud of our independence and consider it beneficial for our customers, but the independence also makes Skandia more vulnerable, as Skandia lacks an obvious sponsor in the event of financial difficulties. The very low interest rates and increased demand on solvency in new regulation sets capital strength in focus. However, Skandia's current solvency situation is indeed very good. As at end of March, Skandia assets over technical provision, which is a common KPI in Sweden, was 160%. But if you go back to the financial crisis in 2008, Skandia's assets over technical provisions was 127%. So, as everybody here knows, even if the solvency position is good today, it can change rapidly. Even though Skandia's financial position is and was very strong, as at the time of the mutualisation, the opportunities for Skandia to strengthen its capital position were considered in the mutualisation process. So let us go through these opportunities. For mutuals, the main means to strengthen the capital position is, of course, through a positive cash flow. However, paid premiums do only strengthen the capital position if only part of the premiums is guaranteed, and this is actually the case in Skandia. The other available financing form for Swedish mutual insurance companies are guaranteed capital, borrowings, and subordinated debentures. As regards the two first forms of financing, there are known limitations. The guarantee capital needs to be repaid as soon as it is no longer needed, and borrowings are only allowed for specific reasons and must be of minor significance in relation to the scope of the business and size of the capital base. Also, only subordinated loans strengthen the capital position. But mutuals also have the opportunity to raise external capital through issuance of subordinated debentures. The subordinated debentures are not subject to the limitations that apply to the guarantee capital, and nor are they, as they are considered borrowings but restricted equity, subject to the restrictions on borrowings. But there are other formal or practical limitations that apply to these issues of subordinated debentures. And these limitations are, of course, connected to the protections of the policyholders. And that is the access to external venture capital. No, wrong page.
You skip the slide.
Yeah. The Swedish legislature has in principle taken a rather positive approach to the mutual insurance companies' need for raising external risk capital. the legislature sees advantages in the increased finance flexibility that the introduction of alternative sources of capital entails, and considers it's beneficial for the policyholders in the long run due to the fact that access to external venture capital usually reduces the risk for potentially costly portfolio transfers or insolvency cases. In a serious but temporary crisis, a capital injection could allow a company's survival. Alternative sources of finance increases the potential for growth and can facilitate investments in new products. The legislator also concludes that in a company with widespread ownership, the mere presence of external investors could lead to a more effective corporate governance. However, it also acknowledged the fact that it is a balancing act between, on the one hand, the mutual principles of internal financing and independence, and on the other hand, the positive effect of a better capital supply. The legal prerequisite for mutual to raise capital through subordinated debentures are the mutual company must amend its article of association to allow profit distribution to holders of subordinated debentures. The amended articles of association must be adopted at the general meeting with 2/3 majority, and the amended articles of association must be approved by the Swedish FSA. Such approval may be granted only if it is assumed that the amendment does not impair the rights of the policyholders. After the amendment of the Articles of Association has been proved, the mutual company is from a legal perspective considered a profit-distributing mutual insurance company. It is indeed a contradiction of terms which perhaps reveals the difficulties of applying this possibility in practice, but I will come back to that later. As regards the Swedish FSA approval, it should be noted that the Swedish FSA was critical to the introduction of the possibility to raise capital from other members, as it considered this to be in conflict with the core principle of mutual insurance companies. This is the requirements for internal financing and independence. From a policyholder's perspective, preferential rights are key. In the event of liquidation or bankruptcy, the policyholder's right to agreed benefits are protected. However, the subordinated debenture holders have a better right to the surplus than the policyholders. Thus, upon dissolution of the company, holders of the subordinated debentures have preferential rights to the policyholders' rights to bonus. So coming back to the balancing act between policyholders' interest and the positive effects of better capital supply, how are the policyholders protected? Well, mainly through the fact that all material decisions need to be made at the general meeting. In addition, all amendments of the articles require 2/3 majority at the general meeting. And as I said before, the Swedish FSA may only approve the amendment of the article if it's assumed that the amendments do not impair the rights of the policyholder. The further details and requirements of such progress are not clear. In my opinion, it is not unlikely that the FSA will require the policyholder to be heard, requiring the same voting results as in a demutualisation process. A subordinated debenture is restricted equity, and therefore no interest will be paid to the investor. An investor can, however, receive a return on invested capital in the form of dividends. As this is considered profit distribution, the decision to pay the return must be made at the general meeting. To conclude, given that the holders of the subordinated debenture have preferential rights to the surplus, the issuance of such debentures can have negative effect on policyholders' rights. Since all materials matter relating to the profit distribution are decided on by the general meeting of the company, the policyholders or their representative must balance the advantage and disadvantages of raising such capital, and the material decisions are in the hands of the policyholders. When Skandia was mutualized, it was seriously considered allowing for profit distribution in the Articles of Association. Not because Skandia needed to raise capital, but in order to have the structure in place should Skandia need that in the future. However, it was eventually decided not to allow that, and that was mainly for the following reasons. Firstly, the inclusion of such language in the Articles of Association would have most likely delayed the applications process at the FSA, as Skandia would have been the first mutual company applying for such consent. Secondly, it would have been such a significant change of Skandia's fundamentals as it was considered appropriate to have the Board of Delegates take a stand in the matter only when the board had reached full strength, and that is 3 years after the mutualization. Thirdly, how would such an amendment of the Articles of Association proceed by the market? Perhaps it would have confused the market, and not to say the customers, if Skandia would have converted from a non-profit distributing company limited by share to a profit-distributing mutual company. Last but not least, the tax consequences for Skandia as a company and the tax treatment of the return are unclear. Although it would have been a good opportunity to include the language allowing for a profit distribution in Skandia, I think the Thule Foundation made the right choice to refrain from doing so. In my opinion, Skandia would still benefit from having such possibility in the articles, but there are, to my knowledge, no plans to insert such language in the articles. So, is the possibility to raise external capital useful in practice? I would say that if the company does not already have the necessary language in the articles, it is not an alternative. The fact that the process in all likelihood will be similar to a demutualization process makes it rather unpractical, as the administration of the FSA requires some time. In theory, an application for the approval of the amendment of the articles can take up to 60 days of handle for the FSA from the day the application is complete. And FSA would probably require the policyholders to be heard, and the application would not be complete before such process is finalized. Although the FSA was not in favor of the legislation that introduced the possibility for mutual companies, FSA would perhaps, in case of a mutual running into financial difficulties, take a different approach, preferring the injection of external capital to costly portfolio transfer or to a liquidation. However, the uncertainty is problematic and could affect the processing time within the FSA. And as everybody knows, in case of financial difficulties, time is of essence. It has been said the fact that no interest can be paid to the investors affects the significance of this financing form negatively. I do not think that that is the main problem. Cooperatives have attracted risk capital through the issuance of subordinated debenture with a return linked to the financial position of the corporation. In my opinion, the uncertainties and complexity relating to setting the return means that the likely investors are affiliated entities. As Skandia lacks such affiliated, the opportunity for Skandia to access external capital may be limited. The main problem, however, is the mindset of the regulatory authorities, the mindset of the customers and the market, and the mindset of the tax authorities. I simply do not think that Sweden is ready for profit distributing mutual companies, at least not yet. Thank you so much.